I'm about to review exactly how smart money are building up their positions and hunting for liquidity. So if you are sick of getting stopped out, you need to watch this video. How many times has this happened to you? You enter for a trade and then the next thing you know, price hit your stop loss and you get stopped out. But then 15 minutes later, the trade ended up going in your way and you end up wondering what in the actual heck is going on? What am I doing wrong? Do you know what you are doing wrong? You are thinking like a retail trader, a brokey, a newbie. That is exactly what you are doing wrong, and that is exactly why you are still losing money when trading. Let me give you an example. So right here, I have my Tokyo sessions marked up by this purple rectangle thing. So in my first year of trading, I remember like watching this online course and it taught me to trade consolidation breakouts, which is basically when price is consolidation, I'm just gonna draw a box around it like this, containing the consolidation, and then what I want to do is to trade the breakout, right? So immediately when price break out the consolidation, I will enter for a position to trade in that direction. So if you break above, I will be entering for a buy, and if you break below, I'll be entering for a sell. And then as time passes, I continue using this strategy and I realized that I only lose money because of this thing called fake outs, false breakouts, liquidity grabs, whatever you like to call it. So the strategy that I was using back then was Tokyo breakout strategy. So during the Tokyo session, or rather the Asian session, price will be going sideways like this, consolidating, because there's not much liquidity in the market and price will just like move sideways, no volatility, and just quite boring like this. So what I did was that, like I said, I draw a box around this consolidation and then I was waiting for price to break out of this consolidation. And when price break out, I will usually trade in that particular direction. So for this example, price broke below it, so I will enter for a sell somewhere right around here. But then for some reason, price never, or rather rarely goes in my way. It always end up going in the other direction and I end up getting stopped out. I end up losing that trade and lose a lot of money, and I keep on wondering, what am I doing wrong? Now this is not Tokyo breakout strategy. It's more of Tokyo trap, right? It's a trap. It's like walking into a hotel with this beautiful 10 out of 10 chick and then undressing her, and then you realize that her thing is bigger than yours. It's a trap. So let me explain why does this happen. So retail traders trading the breakout of the Tokyo session will always lose money like most of the time, because smart money, what they are doing is that they are doing the opposite of what retail traders are doing. Let's say in this scenario right here, right? Let me just go back in time a little bit, and you can see right now price is consolidating, going sideways, right? So I'll just draw my box like this. So I'll be waiting for price to break out of this consolidation. So I'll just wait. And you can see right here, this is when price broke out of the consolidation box. And most retail traders, they're going to be trading the breakout. So they will enter for a buy right here. So if they're entering for a buy right here, they're going to be placing their stop loss at somewhere right around here, right? Because if price end up going down, then they get stopped out. Guess what? They prevent themselves from losing money. So that is what will happen. They will enter for a buy here, and then you see the next thing you know, price goes up a little bit, just a little bit. They're in profit a little bit, so they're a little bit happy. But then the next thing you know, this is an entire fake out, and price went down in the other direction and smashed their stop loss. So why does this happen? So you have to understand, like I said, smart money, they are not like you dumb retail traders. They purposely push the price up outside of the consolidation so that dumb retail traders will enter for a buy, and then they change the market direction so that they can grab like more liquidity. So when this happens, right, the buyers, they get stopped out. Guess what? They have more liquidity now. The smart money have more liquidity to push the market in that particular direction that they want, which is the downside. Now, that's the first group of dumbass retail traders. There is a second group of dumbass retail traders getting stopped out at this point of time. There's another group of retail traders, what they would do was that they would have entered for a sell somewhere right around here, right? They will enter for a sell because they know that this is a fake out and they assume that this is a fake out. So they enter for a sell like immediately right around here. And then they'll place their stop loss above this last swing high thing. They get stopped out also. They also get stopped out. The second group of retail traders also get stopped out. So now both of these buyers and sellers, which is on the retail side, get stopped out. Now who's left in the market? The smart money. The big boys, the major big dick energy boys. And then that is when they enter for a sell right here, push the market in that particular direction that they want, which is the downside, and they end up making a lot of money while you dumbass retail traders lose money. So how do you fix this? Here's the solution. The solution is to trade the fake outs instead of the breakouts. The next time when this happens, when price break out of consolidation, when you see price breaking of consolidation like this, what you must do is to be wary. All right, be careful. Look at what price is gonna do next. Is it gonna come down, retest this box, and then go up? Or is it gonna be a fake out and price is going to reverse and head back down? Could this be a liquidity grab? Those are some things that you must ask yourself. So in this example, what you must do is to wait, right? Be patient to see what price is doing when price break out. And I want you to make use of this market manipulation and put yourself in the shoes of the smart money. Instead of thinking like a retail trader, doing what the retail traders are doing, why not start thinking like a professional trader? Think like a professional. Think about, if I am a professional trader, how will I use this opportunity to stop out all the retail traders so that I can benefit from that move? Their downside, their suffering is my joy. Well, very simple. Just do the opposite of what retail traders are doing. If you know that retail traders, they are entering for a buy here, guess what? Enter for a sell instead. So by doing that, you're able to benefit from this beautiful down move. And of course, if you enter for a sell somewhere right around here, make sure you give your stop loss a little bit of breathing room, because you don't want to put it like super tight like this and then end up getting stopped out by the next fake outs. And the reason why I've marked up all these Tokyo sessions is because if you look at this, right, it's a very common situation. You can see right here in January 2023, same thing happened, right? Price consolidated during the London session, and look at what happens. The smart money purposely pushed the price down, break out of this consolidation box, so that most retail traders, they will enter for a sell right here. And then the smart money, once again, the smart idiots, push the price up and end up stopping out of the retail traders, grab the liquidity, and then end up pushing the price in that particular way. Now that is for consolidation. That is what you should do when price is consolidation and how you can trade fake outs in consolidation. But what if price is not going sideways? What if price is not consolidating? What if price is trending, either in an uptrend or a downtrend? Then in this scenario, what should you do instead? Now this is what I call an accumulation or distribution trap. So as we know that price will never ever just go up straight, right? Price will go up, retrace a little bit, go up, retrace a little bit, go up, retrace a little bit, and go up even higher, creating a higher highs and higher lows in the uptrend. But sometimes when price retrace, it does not just retrace once and then go up. No. Sometimes price will retrace and start consolidating a little bit like this and then go up. So in this scenario, this is what we call the accumulation phase. Now don't be fooled, because when price is accumulation like this, once again, it's another consolidation, right? So there is going to be fake outs, right? Sometimes price will retrace like this and then starts consolidating like this. And then next thing you know, price get pushed all the way down, break through this little low that we have here. And then smart money come in to push the price up even higher. So this is what we call the accumulation trap. So here's a continuation trading strategy where you can use. You can see in this beautiful uptrend, what you want to do is to look for a consolidation after an uptrend or after a push phase. So you can see this example, price got pushed all the way up here. And then it starts losing steam and starts consolidating like this, right? So that's the first step. You want to look for a consolidation after an uptrend. Now, the next thing is you want to identify a spring. So what is a spring? A spring is when, you know those bouncier springs in your pants, it's just like this coil thing, and then just spring up and down, up and down, up and down, right? Same thing with trading. Springs are these things where they are just spiking out of the consolidation. So you can see in this consolidation like this, after you draw a box, you can see there's a spring right here. Price broke out of this box and then went back up. So this is what we call a spring. It just bounced down and then bounced back up like this, and just continue going back in the consolidation. So what you want to do is that you want to trade springs that appear on the lower side of the consolidation in an uptrend. So what I mean by that is that if you look at this uptrend, if you look at this consolidation, you want to trade the springs that happens on the lower side, which is this side right here, the lower side. So you can easily enter for a buy when the market swings higher from the spring candle, right? You can see right here, this is when the swing happened and then the market continue to get pushed up. That is when you can enter for a buy. Now, what you can even do is that you can place limit orders. So you can place limit orders somewhere right around here, so that when price hits that level, your broker will automatically get you into a buy position, and then you can get in for that beautiful trade. So that is one way we can use to save time. Use limit orders. Now, in a downtrend, it's basically the opposite, right? So once again, in the downtrend, you want to look for consolidation. So I can see there's this major consolidation somewhere right around here. And this time round, you want to trade the springs that is at the upper side of the range. So upper side of the range is this side right here, right? So you want to trade the springs that is on this side. And you can see in this case, price broke out of the upper range right here and then went back down. So this is what we call a spring. So easily enter for a sell somewhere right around here when the spring happens, and you can take it down, 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 and just short that shit down. Now that is exactly how you can trade like the smart money and punish the retail newbie traders. Welcome to the uncensored section. Do you ever go onto social media and you start seeing someone who is more rich than you, someone who's a more better trader than you? He's driving a Ferrari. Oh, he's making $10,000 today, while I only made $50 today from trading. Oh, he's living in a mansion and he's living the dream life. He has location freedom, time freedom, financial freedom, while I'm out here slaving at my job and still trying to learn how to trade. My advice for you would be to not compare your chapter 1 to someone else chapter 20. Comparison is the killer of trading. Just like you, even at this stage of my life, when I have achieved everything that I ever want to achieve, not really everything, but I have achieved like financial freedom, location freedom, time freedom, whenever I still open my social media, I still see someone richer than me. I still see someone who has made millions from trading. I still see someone who made $100,000 today from trading, while I only made about $10,000. It's a never-ending journey. There is always someone out there who is better than you, no matter what you do. Even if you are Elon Musk, there is still someone out there better than you. Comparing yourself to others actually leads to self-minimization, which is basically a term for a lack of confidence and self-worth. Think about it. When you compare yourself to that millionaire trader, you start to think like you are a shitty trader. You start to think that the millionaire trader is above you and he's built different. There is no way that you can reach that level. And that actually causes you to lose your self-worth. That actually causes you to lose your confidence. You start to think like, I will never ever become the millionaire trader. I will never ever become like the trading geek. That is the wrong mindset to have. Whenever we compare ourselves to other people and assume that they have something that we don't, we put them on like such a pedestal and self-minimize as a result. We start to think that we are actually shitty traders, when in fact, you have the qualities that the millionaire trader have. Are you putting in the work? Yes, so is key. Is key discipline? Yes, so are you. Now, I'm not asking you to completely stop comparing yourself to him. Yes, you should still respect that particular trader, that millionaire trader. Chances are he has put in the work much more than you do. So you have to respect him. What I mean is that do not put him on such a pedestal that you think that you will never ever become like him, that millionaire trader. And I'm also not saying that you should completely stop comparing yourself to others, because the truth is life is a competition. Chances are, especially if you are a man, life is a harsh competition for you. If you do not work hard enough, there's going to be another man out there who's willing to work harder than you, who's more good looking than you, who's more richer than you, that's going to take your future wife. So yes, to a degree, you should always compare yourself to others. Compare yourself to others so they can see that you are worthless and you are broke. And you need to improve on yourself. But just do not put them on such a pedestal that you think that you will never ever achieve them. Because chances are a lot of these millionaire traders, they came from nothing too. Just like me, I came from nothing. And if I can do it, you can do it too. So the solution to comparing yourself to others is to find the action that you are admiring in this particular individual, this millionaire trader. That action could be hard work or discipline or meditating, or it could be some simple qualities like he's kind and you are kind too. And then find the moments in your own life where you demonstrated the same action in your own form. So if you respect this millionaire trader, if you look up to this millionaire trader and you see that he has the discipline to do what it takes to become a successful trader, he has been disciplined for years now, he has been putting in the work, he has been journaling his trades, then the next thing you should do is to think about the moments in your own life where you have demonstrated the value discipline. Oh, I went to the gym. Oh, I journaled down on my book. I journaled down my trades. I actually reflected and see what went wrong. Oh, I meditated today even though I didn't feel like it. All of these things shows that you have discipline. You have discipline, the millionaire trader has discipline. There's not much difference between you both, isn't it? So start thinking in that way and own it 100%. You have what it takes to become a millionaire trader. You have what it takes to become like the trading geek. You have what it takes to become like Q Banks, to become like Raja Banks, ICT. You have what it takes. What you need to do is to stop putting these people on a pedestal and think that they are gods and you will never ever be like them, because you can be like them. Believe that you will. Like I said, do not compare your chapter 1 to someone else chapter 20. That millionaire trader probably has been trading for years now. He did not get rich just because he have been trading for 1 month. That's bullshit, alright? So what I need you to do right now is to go and reflect on what I just told you. Alright, because knowledge is nothing unless you applied it. So smash on that like button if you have enjoyed this video and you have learned something, and smash on that subscribe button, baby. And remember, you are just one trade away. Mwah. Click on this uncensored trading episode, baby.